Myself Ram Kushwa from SS Institute of Management Studies. Today my topic is future and options markets in India. Introduction about future and options. When NSE introduced Nifty future and option in 2000, followed by stocks F&O in 2001, it replaced the Batla system in India. Over the last 20 plus years, trading volume in F&O have gone up exponentially. Today, National Stock Exchange is the largest derivative exchange in the world. Definition of future and options. Future and options are the most common derivative contracts where two parties enter into a contract. It is speculative in nature and considered a safer option than the market share. Things you need to know about the future and options. All contracts have an expiry date. Each contract represents an underlying stock index in the spot market. The future price moves in tandem with the underlying assets. Contracts are traded in the fixed lot size and multiplied therefore. Index future contracts are valuable in monthly series, while index future options are valuable on weekly and monthly expiry. Stock and future options are valuable only up to 3 months. Future expiry dates, where one can trade in index contract up to 5-year future expiry dates. Due to the strong elements of speculation, the future option segment usually sees hedgers or speculator trading in it. The maximum durations for a future contract is 3 months. The basic difference between a future and options are a future contract requires a buyer to purchase the shares and a seller to share on a specific future dates. Option contracts give the buyer and seller the rights, but not the obligation to sell or purchase. So, if needed, you can option out of your opinion and given time. Now, let us understand the basic difference between future and options. A future contract requires a buyer to purchase the shares and the seller to sell the shares on specified future date, unless the position is closed prior to contract expiry date. While an option contract given the buyer and seller the right, but not the obligation to buy and sell the shares at a specific price at any time till the contract is in effect. So if needed you and can option out of your options can given a time. But what wouldn't be possible in case of futures where the trader must have take place at specific date. There are two types of options called puts options and two categories. If you are bullish on a stock, index are experts in the price to rise in future. You can buy a call or sell. And if you are bearish on stock index and expect the of a price to fall, you can choose to a puts option. Who trade in F&O? Institutional investors, both foreign and domestics, high net individual, hedge funds, and arbitrage, and retail investors, all three futures and options are said to be the high risk trading. Instruments given the higher capital requirement in terms of minimum quantity to trade. Yet these are seen as to go to the product by traders and speculators due to ample liquidity, mainly in the index contracts such as Nifty and Bank Nifty. The trading volume in the future option segment is considerably higher. Risk management strategies. The Union Budget of India, also referred to as the annual financial statement in Article 112 of the Constitution of India. The, the annual budget of the Republic of India is the government present it on the first day of February so that it could be materialized before the beginning of a new financial year in April. Indian stock markets have witnessed a high volatility during the most Union Budget announcement in the last 10 years. With the high volatility come risks and opportunities. In this article, we will discuss popular future option strategy trader adopt and how can one manage risk better while maximizing the returns. Here we can see the Nifty Bank Nifty intraday price charts from March 12 to from 1 November 2020. Here we can see the Nifty Bank floating increasing day by day. in first March 2012 is 4.68%, and in 1st November 2020 it reached to 7.76%. Here we can see the Indian market has been growing increase by day. What are the various option strategies to play the budgets? Straddle and straddles are both common option strategies that allows the investor to benefit from significant moves in a stock price, whether it moves up or down. The difference is that the straddles has a two different strike price, while the straddle has a common strike price. A long straddle is an option strategy that involves a purchasing both a long call and a long put on the same underlying and same strike price. A long triangle consists of one long call with the highest strike price and one long put with the lowest strike. The higher is that the market may not react strongly enough to the event or the news is generated. The premium paid becomes your risk. You can check your payoffs with the ICICI Direct and execute this strategy at a click with the new basket orders. Here we can see the Nifty's and a payoff and today's payroll. Nifty is 850 and payroll is 8829 and in expiry payroll is 8547. And here we can see that Nifty is 8150 and today payroll is 67439 and expiry payroll is a minus 64552. Levels are 800 200 and today payroll is a 1418 and expiry payroll is a minus 8952. What are options? Another kind of derivative is the option contract. This is a little difference from the future contract is that it gives a buyer or a seller the right but not the obligation to buy or sell or a particular asset to a certain price or specified predetermined date. There are two types of options, the call option and a put option. A call option is a contract that gives the buyer the right but not the obligation to buy a particular asset at a specified price on a specified date. Let's say you are purchase a call option to buy 100 share of company APC at rupees 50 each on a certain day, but the share price fall to rupees 40 below the end of the expiry period, and you have no interest is ongoing through with the contract because you will making losses. You then have the right not to buy the shares of rupees 50, and instead of losing rupees 1000 on the deal, your only losses will be the premium paid to enter into the contract, which will be the much lower. Another type of option is the put option. In this type of contract, you can sell assets and an aggregate price in the futures, but not the obligation. For instance, if you have put the option to sell the shares of a company APC at rupees 50 at a future date and a share price rises at rupees 60 before the expiry date, you have the option of not selling the share of rupees 50. So we like to avoid the losses of 1000. Future options in commodities. Future options in commodity are another choice of investors. However, commodity markets are volatile, so it's better to venture into them only if you can bear a considerable amount of risk. Since margins are lower of commodity, there is scope for considerable leverage. Leverage may present a more opportunity for profit, but the risk commodity is higher. You can trade a commodity future and option through commodity exchange like the multi commodity exchange and the National Commodity Derivative Exchange Limited in India. It is important to know what are the functions and options since they have played an essential financial role in the world. They help hedge against the price fluctuations and ensure that the market are liquid. A savvy investors can also profit by investing in these derivatives. I would like to conclude myself. An increase in the stock price causes an increase in the wealth. Consequently, an increase in the consumer spending. The stock market affects the economy also. Investment is also affected by the higher price. With the higher stock price, a firm can raise some money per share to investment projects. Thank you.